Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Church and Dwight Company, ticker CHD. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, we can see the market cap is $23 billion, EV is $24 billion, which means you have about a $1.5 billion of debt leverage on this business that's allowing you to get a little bit higher returns than you otherwise would. You have household products industry, which tends to be a pretty good industry, the developed manufacturing market, household personal care and specialty products, 3 segments, consumer domestic, international specialty products division. It looks like we have some bolded brands. So this is going to be a branded products company, tells you a little bit about it. I can name off some of these brands. We have Arm & Hammer, we have Trojan, we have OxyClean, Spin Brush, First Response, Nair, Orajel, Extra, Little Critters, Vitafusion, shampoos under Batista, Waterpik brand, Flawless, Zicam, TheraBreath, Megalac, BioChlor, Fermentin, and Celminox. So I recognize quite a few of those brand names. You probably do too. Some of these are actually really good industries, like the baking soda industry. I mean, there's almost no competitor that I would have considered. Usually then I just pick up the Arm & Hammer brand. So that suggests it's going to be a relatively good, strong industry. Backing this up is you see a beta of 0.42. That's a really good number because the lower the beta below 1, especially below 0.5 in an S&P 500 company, means it's going to be relatively low volatility of the stock price, which probably means low volatility of the business. And when we go down to the return on invested capital chart, this is a really good looking chart. Look at the stability year from year. There's very little change in return on invested capital year from year. For the most part, every year is relatively about the same, maybe a little better. You see a general improvement across the last 2 decades. And every year for the last 2 decades, you have had a profitable year. So that means 20 straight years of profits, 20 straight years of relatively good profitability. Every year since 2009, you have had double-digit return on invested capital, which is the threshold I like to see. And you've been improving that. So in 2009, you were at 10%, then 11%, 13, 13, 13, 13, 13, 14%, 19%, 12, 13, 15, 15. So you're at around a 15% return on invested capital, and it's been improving over the last 2 decades. So I could maybe even expect maybe a further improvement. This is a really, really good setup to have for a company. Everything here screams extremely high quality. 10-year median returns, return on assets 9.7%, return on invested capital 13%, return on equity of 23%. All these numbers are really good, high quality right there. Now, first hiccup we have is valuation. PE of 28.7 is very high, and this is backed up by other high numbers like price to book of 7, price to sales of 4. All this suggesting that you're certainly paying up for the high quality business. Now, I think this number is probably a little too high to pay for any company, even a high quality company. High quality businesses, I think a lot of times trade around a PE of 20 versus an average business paying around a PE of 15. So if we could get a little cheaper, closer to that 15 to 20 range, I could be really excited. But this is a very high quality business, maybe a little bit overvalued. But with the right growth numbers, it could run into that. Now you see revenue growth of 6.6, and asset growth of 9.9%, EPS growth of 12%. So you're outgrowing your assets, you're outgrowing your revenue, showing some operating leverage, but also probably some buybacks here that's boosting this EPS number. All of this is looking really, really good with these return on equity numbers, return on cash flow numbers. You're able to self-fund all this growth, which is a really good sign for the future. And if I think we're going to see some of that operating leverage we do when we see revenue going from 2.9 billion to 5.1 billion. So that's less than a double. But then when you look at EPS at $1.23 to $3.33, you're basically almost a triple on earnings without even having doubled your revenue. That's showing that really good improvement on the bottom line. In addition, you have been paying out dividends that whole time. So you're actually doing really well with that, being able to pay out, anywhere from a third to half your earnings in dividends and still achieve that growth, it's very, very impressive. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe. Your subscriptions help me to grow the channel. And when you subscribe, you can ring that bell and get notifications as I upload new videos each and every day covering every company in the S&P 500. And then I'll continue after that with even more companies. So if you want to learn about different companies, you want to learn how to analyze financial statements, then please subscribe. So income statement. Let's take a look at what we can see here on the income statement. 10 straight years of gross profitability, 10 straight years of operating profit, 10 straight years of net income, all really, really good numbers. In addition, like I predicted, you do have share buybacks. So you start out at 280 million shares outstanding, you end at 245 million shares outstanding. Now, importantly, it's not occurring every year. You do have basically flat for the last 4 years. There were more share buybacks before that, but it's basically been flat for the last 4 years. So I want to understand why that might be, if they've changed that program, or maybe they're just diluting a little bit. See if we can learn more from the balance sheet. So PP&E is actually a really good thing that you like to see, is nearly flat. So your PP&E is up 20% over the course of the decade. So you've grown your property, plant, and equipment from 500 million to 653 million, but you've grown your income over 2.5 times. So 20% increase in assets there has been led to a much higher increase in your profitability. Very, very good sign. Now there's other growth here. You've had to grow in inventories, you've had to grow receivables, all those things have grown as well. But on the true PP&E side, that's actually a really good setup. Now you have grown in goodwill and intangibles, which is why the return on equity hasn't just grown through the roof, because there's some sort of acquisitions and stuff happening there. But it's something to be aware of. They have grown that debt. You do have that like $1.5 billion in debt leverage that I talked about. So you can see that here. That's giving them that boost from the return on equity number, from this return on invested capital to this return on equity number. Balance sheet, what else can we see? Let's go to the cash flow statement. So positive cash flow from operations, we'd like to see that. You see this cash flow being appreciably above the net income. That's driven almost entirely by this depreciation and amortization. They do have stock-based compensation. They've gone from 12 million to 24 million across the decade, but that's always been substantially lower than the net issuance of common stock. Although I'm a little curious why you're not seeing much retirement in shares if you're doing that. Are they issuing shares? They have had acquisitions, so maybe they've had to issue it. Is it cash from financings? I don't know if these are equity financings or what's going on for those acquisitions. But this is a little weird, because if we look at the income statement, we can see that you basically have flat shares outstanding across those last 4 years. And if the cash flow says you've used 200, 250, 300, 500 million buying back stock during those years. So either these numbers are understated on the stock-based compensation, or something's being missed here. You'd want to study it further. The 10K will have more information that will lay it out for you. But you do see they're spending more money on buying back shares than they are on paying dividends, and the dividend has been growing over time. The share buybacks have been growing over time. Those are generally good setups that you like to see for long-term performance. They have been making steady acquisitions, so you need to take that into account as part of their ongoing planning. Overall, everything here looks great. This looks like a really, really strong business. The revenue growth at 6 or 7% is fine, but it does mean you have to be careful about overpaying, because you're not growing revenue at double digits. You can't simply pay up a huge PE like this at a PE of 28 to 30. You really want to be paying that PE of 15 to 20. But if you are able to get this at a really good price, then this company looks extremely attractive, because everything is said here, 20 straight years of profitability, very stable, growing return on invested capital. Everything looks good. The capital allocation is intelligent. You're paying out a dividend. You're still growing at double-digit rates with that dividend. So everything's set up here for double-digit returns to the shareholder, potentially exceeding this 10 to 12%. So you're going to get returns in that 10, 15, 20% range if you buy a company like this and they continue this past historical growth. So for me, that's what lets it go on my watch list. If you enjoyed this video, please hit that like button. Don't forget to subscribe. I need your subscriptions to grow the channel, and they help you know when I upload new videos so you can become a better investor. If you've enjoyed this content, please share it with someone. Thank you very much.